Welcome to the PlanStrongerTV market update for Wednesday, June 3rd. Let's dive right into the numbers. There are your numbers for 2025. Just as a reference point, you'll see all of the major indices that we follow, and then we'll slide those over and put the year-to-date through the end of May for 2026. And you can go down the line there and see strong numbers really across the board. Bonds basically flat. And again, I know I repeat this almost on every update we do. These are raw numbers, they're not annualized. So 5 months, if you want to annualize them, multiply by 12, divide by 5, and you get an actual annualized number so you can compare that to the 2025 year total return numbers or any other years you want to compare it to. And of course, 5 months doesn't make a year. 5 months does, and a year doesn't make 2 years. 2 years doesn't make 5 years. So we have to be careful in extrapolating. But the point and the key takeaway is that the market's doing well. And so here to help us understand the nuances and why the market is doing so well is, of course, Robert Meyer, our Chief Investment Officer. Robert, somebody looking at those numbers, they go, wow, the market's on fire. This is great. In a nutshell, what is driving the growth of, and it's not just one particular index, really we're seeing strong performance across the board, again, except for bonds, and I know we can talk about that one differently, but what's driving the enthusiasm?
And you know what, my answer is not going to be, very unique. I like to think it is most of the time, but, really it's a regurgitation of what everybody hears in the news, and that's two letters, the AI. AI, its build out, the way it's impacting businesses, the way it's impacting, and not just the large companies, they do it in different ways. For the large cap companies, the semiconductors, they're providing the material, the semiconductor, the microprocessors, the hardware for the AI, and that huge demand drives their sales and drives their revenue. But the mid and smaller companies, they're starting to utilize the AI and get more efficient, and that helps their bottom line. So you have small, and as you can tell, small caps up almost 19% year to date. So you have the mid cap and small cap companies, surging as well because of their bottom line. So one thing is corporate profits. Profits have just exceeded expectations yet again for the quarter. So, what's driving it? AI, its build out, and all the tangential items associated with AI. That's why the market, those stock indices, are doing so well.
Okay. Well, and it's interesting to note because, one of the big headline news items about artificial intelligence is that it's going to take away jobs, put people out of business or people out of jobs, and, be just a huge impact going through different markets and businesses and destroy models and, like a buggy whip, right? When the cars came along. But we're not seeing that. We're seeing a shift in what people are doing to do the build out. Now, is this a little bit of, a temporary thing, Robert, where we're going to have all this a lot of work that's going to then result in the infrastructure build out for AI, and then it's going to lead to, okay, good, thanks for building it. Now we don't need you, and there's a lot of other jobs we don't need anymore.
Well, I think there's that's a component of it, but it's a structural change. And it's going to be continuous, and it's going to be over several years. But for example, yesterday, we just talked about the JOLTS numbers last month, the job openings and labor turnover survey. Well, this month's came out yesterday, and sometimes a data point comes out, and I have to look at it 2 or 3 times because it's such an enormous move. So last month, we had I'm looking at my numbers, 6.68 million or something with 6.68 million job openings. And I look at the current number, 6.887. I apologize, there it is. And I looked at the number yesterday and I said 7.618. I'm like, there's something off, 7.6, 6.8. In 1 month, 731,000 additional job openings materialized. So
that's a lot.
That's an enormous move for 1 month. So where did 91% of that came from? And the manufacturing and construction sector, again, for the AI build out for data centers. So eventually, yes, those jobs will come back down because you can only build so many data centers at one time, and that will continue, and some become obsolete and you rebuild them, refurbish them, et cetera. But what we're seeing right now is AI, yes, it is displacing some jobs in a few sectors. I'm going to get to that in a moment. But as far as the manufacturing and the construction industry, professional business services, enormous job creation in the last month. So what is hurting? Well, this morning I did something. I Googled and utilized a little AI. So the ones that hurting is the information sector. I said, okay, well, in the JOLTS report, what comprises the information sector? What employees? And it said, Google spit this out, quote, this sector comprises all occupations within companies primarily engaged in producing, distributing, transmitting, or processing data. Basically, end quote. Basically what AI is served to do. Here's some things. Publishing industries like newspapers and magazines, software developers, motion picture and sound recording, broadcasting, telecommunication, and as said before, data processing, hosting, cloud services, web portals, and other information services. So those are the jobs that we're seeing a loss of a lot of jobs there. I remember, 10 years ago, college graduates, I'm a web host, I help people build websites. And now people can do it on their own. There are sites that you just input what you want and AI does it for them. So those are the kind of the positions that are hurting, and those that have been doing that, they have to learn, adapt, learn to live with AI and kind of adjust their skill set in order to, be employed.
Okay, that's a lot. There's a lot of impact that we're seeing and watching it develop. So with all of that excitement, Robert, that is, of course, not only the build out and the employment impact, which is good, and goes against the grain with sometimes what we see from the media. And that's part of my job when we do these updates, is to remind you that if you're seeing negative information about the economy or unemployment, Robert's given you the data, or as sometimes people call it, he brought the receipts, right? So if you're seeing that disconnect, then maybe reevaluate where you're getting your news, because it's not necessarily factual, because those are facts about what's happening. Now, that doesn't mean everything's peaches and cream and that everything is all doing well, or that all of it will continue to do well. There's got to be some soft spots in all of this, Robert. Any particular industries or markets you're seeing right now that aren't as in favor or doing as well as some of the others that maybe we should caution people about?
Well, let me just say, the tech industry 7 months ago in November, there was a big downturn in November because the AI hype went from exactly that hype to, oh, wait a minute, these companies have to spend a lot of money and therefore affecting their bottom line. So you saw in November a pretty good dip, a little dip, not anything large, but people were getting really scared. Well, what's happened since November? You see the numbers. We put up there at the beginning of the show each and every time. Oil and gas companies, energy, did very well, at the start of the Iran-Iraq war, but they've come down. So, when you ask, well, so what's doing pretty well? And we answer that question, like this sector is going to do well, this sector should do well moving forward. But what you're seeing is a lot of cyclicality, a lot of ups and downs. But the point is, when you have these numbers, these fantastic numbers, there's always it's always a double-edged sword. So what do I mean by that? Let me give you an example. We said, gee, the markets are doing great. Well, you know what? Investors are saying, okay, let me see. Labor's doing very well. AI is doing great for manufacturing and construction. Oil markets are doing well because of elevated gas and oil prices, and hopefully those need to come down. But where does that put the Fed? Wow, we have strong economy. We have inflation is going up a little bit, but not nearly as bad as people as the media would have you believe. But why would they cut rates? We have a strong economy. We have expanding manufacturing, expanding GDP, fantastic job numbers, which everybody says are going to deteriorate. We're not seeing it. So there's always a double-edged sword. Will this continue? No, we're going to have pullbacks. Volatility will come up. Fear will grip the market. But the important thing is staying invested, because these numbers will come down a little bit sooner or later, and but they're not going to continue to go down forever, and they will spike back up and continue up.
Yeah, well put, Robert. So a couple key points I want to leave you with. Number one, as Robert said, I'll say it maybe a little bit differently, that there's going to always be something going up and something going down. Different sectors, different industries, different parts of the world, they don't all move in lockstep. There are times when we see a lot of things go up, but as Robert said, with oil and other things, that some of these things are going to move differently than we might expect, and also not all together. They're not all in sync. And then the other thing, which is right on the money, Robert, which is that despite what we see and hear, it is normal. It is normal to have pullbacks. A pullback is a 5% drop from a previous high. It's common. Sometimes we get spoiled and we have a very short memory. So on average, a pullback of 5% from a previous high happens historically about every three or four times a year. That doesn't mean every year 3 or 4 times, but on average, you see a pullback. So 5% pullback is common. If you cannot stomach a 5% drop in your portfolio, then your money shouldn't be there. And if you're going to be using it for income, or you're going to be drawing on it soon, it shouldn't be there. A 10% drop, we call a correction. They happen about once every year, about every 12 months. On average, not every year, but on average, about every 12 months. Same thing. And then, of course, bear market, 20% drop happens about every 6 or 7 years. And so not a frequent event, but that doesn't mean that if we have one, the last one was in 2022, that doesn't mean we're safe until 2028. It means that it happens every 6 or 7 years, but here we are in 2026, and even though we might not be due till 2028, it could happen tomorrow. So you have to build your portfolios and have your money arranged in a way that allows you to be resilient and be able to use that money when you plan to use it without the risk of it being down when you need it. How's that, Robert?
That's a wrap.
That's what we call sticking the landing. So, but we're doing this every day, and we're sharing with you so that we can help you continue to plan stronger.